Would be pleased to introduce Stephen Bigalow. I think I first met Steve back in, I'm going to say 2003, a long time, worked with him for years. He is the founder and owner of Candlestick Forum. Steve personally has 40 plus years of investment experience. He had 8 years as a stockbroker with major Wall Street firms, including, let's see, he had a business economics degree from Cornell, author of 3 top investing books that teach trading with candlestick patterns. And he's my favorite candlestick chartist. So Steve, we're going to get your presentation up and going, and Raleigh's going to review exactly what you're going to share with us today.
That's great. And yeah, Steve's going to be talking today about identifying bullish and bearish market sectors, something that he is just fantastic at. He's going to show the 2 major activities that are driving this sector potential, how candlestick patterns reveal investor sentiment, and using the RARE process, R-A-R-E, that he has developed for finding the best opportunities in the market. And with that, Steve, welcome. Delighted to have you here with us. Why don't you go ahead and come on board, grab the screen, and let's get rolling.
Okay, thank you, Raleigh. Thank you, Pat.
Hey, where's your video, Big?
Oh, I don't know. How does first, can you take a quick survey? How many people have seen my presentations before? That way it'll give me a way to know how much description to do on each screen. I guess if you've seen my presentations before, put in Y, if not, no, and Raleigh just kind of give me a percentage of.
So far, we're about 75% yes.
Okay.
And there's a couple of no's, more yeses. I would say it sounds, no, maybe it's about 50-50, Steve.
All right. Okay, well, here we go. So the return of the bear was kind of going to be oriented toward, if the new administration came in, there was going to be some assumptions of which sectors might be acting positive, such as the green energy area positive, fuel cells negative. So going back to the basics real quickly, there is about 12 major signals in candlestick analysis. Out of the 50 or 60 signals, all you need to know is these 12, because they will provide you with more trades than you'll ever be able to handle, and you'll be very able to accurately assess what is going on in the market or in any price move. There's about 6 or 8 patterns, and this is because human nature works the same way time after time. So we can identify what's going on in investor sentiment by major factors, such as politics, world events, or sector potential. And so here's kind of the evaluation. You can see what happened with the expectation of oil and gas under Biden, with everybody wanting to go green, that it might be a sell-off when it got to the inauguration day. But you can see that this sector has been acting strong ever since then. Why? Because some of the ramifications of cutting out the pipeline and that sort of thing let prices in that sector go higher. So this is one of the basics of what candlestick analysis provides for investors, is it allows us to see exactly what is happening in a sector or in a stock price, not what we think we are seeing or hearing. I kind of illustrate that with the 90-year-old guy that comes into the doctor and said, I need to do a sperm count. My wife and I want to have a baby. And the doctor kind of looked at him and said, all right, here, take this bottle, take it home. You know what to do with it, and bring it back tomorrow. The next day, the old guy comes into the office and the bottle's empty. And the doctor said, well, what's happened here? And he goes, oh, I went home and I went into the bathroom. I used my right hand, nothing happened. I used my left hand, nothing happened. I had my wife come in. She used her right hand, nothing happened. I told her to use her left hand, nothing happened. I made her use her mouth with her teeth in, nothing happened. I made her use her mouth with her teeth out, and we still couldn't get the top off this damn bottle. So I tell this story because lots of people anticipate what might be the outcome of that instead of what was actually going on. And that's exactly what the relevancy of Candlestick, I know, but I just wanted to illustrate the point that the charts tell you exactly what's going on. So here's the benefit we have from these charts is the fact that we can see which sectors are going to benefit by, in this case, political changes. So there's inauguration day. We can see that the bank started trading higher. Now here's what we call convergence analysis. This is Bank of America. When you can put multiple reasons for bullish confirmation, like one, a doji right on the 50-day moving average. Remember, a doji is one of your 12 major signals showing indecision. And two, it's in the oversold area. Three, they gap it up, creating what we call a best friend signal, one of your most powerful signals. Four, it closes above the T line. Five, you have the T line rule, which I'll get to here in a minute. And six, now you have a J-hook pattern setting up. So everything that we could add together told us this was an excellent time to be buying this particular stock because of convergence analysis. Multiple reasons why that uptrend is going to stay in progress. So the T-line rule is probably the most effective thing that you want to walk away today with, if nothing else. Remember, the candlestick signals are the graphic depiction of everybody buying and selling during a specific time frame. The T-line rule is very simple. If you see a candlestick buy signal and a close above the T-line, you can stay long until you see a candlestick sell signal and a close back below the T-line.
Fucking awesome.
Conversely, if you see a candlestick sell signal and a close below the T-line, you can stay short until you see a candlestick buy signal and a close back up above the T-line. When I first started using candlesticks, I was one of the worst investors in the world. I'd been a stockbroker for 8 years. I discovered the brokerage firms had no more idea about what stocks were going to go up or down than the man on the moon. When I started looking at candlesticks, I said, this makes sense. And the more I looked at it, the more sense it made. And I started making good money. In my case, making good money was I wasn't losing money anymore. I was in the right place at the right time. And then one of my first private training students showed, illustrated the T-line, which is the 8 exponential moving average. When I applied that, my profits started soaring because I didn't get whipsawed in and out of positions. So there's another truism that because the T-line acts like a natural support and resistance level of human nature, and the graphics of candlesticks are the illustration of investor sentiment. When you combine those two, you've got an extremely powerful, high probability trade platform. So one of the truisms is the further away you move from the T-line, the higher the probability it's going to come back and test it. So you can see in Tesla a while back, our options trading room made huge profits because they could see that up here in the overbought area, the Japanese race traders tell us where do most people buy? They buy exuberantly at the top. How can we tell exuberance is coming into a trade? You can see the magnitude of the candles and you can see the distance away from the T-line. So what's our trading rule? You can stay long until you see a sell signal to close below the T-line, with the caveat that the further away you move from the T-line, then you flip to your 10-minute chart. And as soon as the 10-minute chart starts trading back below the 10-minute T-line, you start taking profits up here and you don't lose all that profitability. So the T-line in combination with the candlestick signals is an extremely powerful combination. It's combining a natural support and resistance level of human nature, and the signals themselves are telling you what the graphics of investor sentiment is. So we could tell which sectors were going to be strong or weak. The steel sector started selling off there in late January, late January. Home health care. So all this is doing is putting us in the right sectors at the right time in the right direction. Personal computers, same thing. For some reason, they were selling them off. We don't have to know why. We just know they've decided to sell these off. We can see exactly what's going on in investor sentiment. Raleigh, I should have mentioned to you, if people have questions, tell them to type it in and yell them at me. I'll be glad to answer as we go along.
That sounds great, Steve. Make sure that happens for you.
All right. So here's what we're seeing right now in the markets. You can see what the nature of the market was here for the last few weeks. Indecision, 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 and they couldn't get up above this level. They had a big day last week and it reversed. That's telling you there's been a major change of investor sentiment. Right now, I think we're even trading down here today. So this told us that with stocks in the overbought condition, as we were seeing, I use stochastics, 1233 slow stochastics to tell me if I'm in the overbought area. And the Japanese rice trader's logic is, if you start seeing sell signals in the overbought area, the probabilities are pretty strong you're heading for a downtrend. If you see a candlestick buy signal in the oversold area, the probabilities are pretty strong you're heading back in an uptrend. And notice in this case right here, look how far away you've moved from the T line. That made that buy signal that much more relevant. At the same time, we can analyze that things were rolling over when you had a candlestick dark cloud signal and a close below the T line. Now here's one statistic that works extremely well, and that is anytime you see something trade below the T line after a sell signal, the probabilities are extremely strong that you're now heading into a downtrend. So things like Apple, sell signals up here, gap down. Remember what a gap down after a sell signal tells you. But not only have they changed their mind, but now they've told you which way they want to go with great enthusiasm. Right now, Apple's doing a bearish J-hook pattern, which tells us there's prospects of more downside, not only in the market, but in Apple also. So when we start seeing sell signals, the logic is if you're trading positions, you might start adding short positions to the portfolio. So we got a resistance level up here, and now we're starting to see a close below the T line. How long do you stay short? Until you see a sell or a buy signal to close above the T line. This one's still heading down right now as a bearish J-hook pattern. This is what we call a blue ice failure. You could see when they started selling wave one, they came back up, and the blue ice failure is somebody falls through the ice. They can't find the hole they fell through, so they drowned. Where are they going? They're going to the bottom of the pond. So what we're doing, I've always told people in the past that you don't have to know the fundamentals of a company because the fundamentals are already built into the buying and selling decisions of everybody buying and selling. But we've now discovered that if you're looking at things that are changing because of political changes or a sector that might be extremely strong and you don't know which stocks in that sector are going to be the best, this is what we call RARE, research analysis reverse engineering, which basically tells us if we've got a strong sector like electric vehicles, which we think is going to be a very strong sector for quite a few years, and biotechs, there is no way you can keep track of what's going on in each one of those companies. There's hundreds of them. But what we can do is when we see a breakout, instead of us now saying, oh, there's a breakout, now we go back and find out what created that breakout, especially in a strong sector like the electric vehicles. If somebody's come up with a new innovation or a new advancement that's going to put them in the lead, we can confirm that's coming out of a fry pan bottom, breaking the breakout level, and there's reason to be buying this because of whatever the news was. So we also can use the T-line or the doji rule. Doji rule basically says, when do you take profits from a trade like this? Well, look how far away you are from the T-line. And then you have a doji. And the doji rule, the Japanese race traders tell us, is if it opens lower the next day, you start taking profits because the probabilities are extremely strong. That's where the selling is coming in. In this case, we can also see how far away it's from the T-line. Where do you think the next target will likely be? At least back to the T-line. So our rare process, because the electric vehicles are going to get so much more attention because of the green policies of the Biden administration, when we see something like this, that was on the, this was on, I'm sorry, this was a different one. This was Rite Aid being affected by the virus vaccines. So we would look to see what the news was to see whether this best friend signal, which is one of your powerful bullish signals, is a doji followed by a gap up. That tells you there's going to be more upside. We can now research and say, all right, what was the news today that created that news? Was it just an upgrade, which might not be a strong uptrending process, or was this news that was going to move this stock price higher? So basically, this is just pure common sense. If we see a candlestick signal pattern breakout, we just go back and find out what the news was that created that move. So that's what we're looking at in this rare process. What caused the breakout alert? This is the one I was looking for, workhorse. It gapped up on the day that Biden announced that by, 2025, all government vehicles were going to be electric powered. That told us there was probably a lot more upside. We could be buying on that breakout day. Or world events. Obviously, the COVID virus was telling us we wanted to start looking at the drug sector, about the vaccines or generic drugs. This told us we at least start looking at stocks in that sector to tell us which stocks in that sector, that the whole sector is going up, has the strongest upside probabilities. And so this is saying why the electric vehicles, because the administration is advocating that everything should be moving toward electric vehicles versus the old gasoline engines. And so if we've got a long-term outlook that whole sector is going to act strong, what we want to find out, and that sector is being advertised by charts like this, where Tesla is up 700% over the last couple of years. NIO was up over 1,000% over the last couple of years. So there's no way you can keep track of who's got the next best innovation that's going to put them ahead of everybody else. So what we're looking for is the breakout alerts. CIV in that sector. When it did this after months of trading flat, it just told us, let's go back and see what they announced. Whatever they announced that day inferred there was going to be more upside. Now, again, look at our T-line rule. How long do you hold on to a position? As long as you don't see a sell signal and a close below the T-line. So when you combine this aspect, that there's new investor sentiment, is this just a quick pop and rolling over? We don't know. All we have is a simple rule that you just stay long until you see that sell signal and a close below the T-line. This is what causes the alert. Kind of a little slow curve right off the 50-day moving average up through the 200, up through this level. What was the news, and was it worthy enough that it was going to create more upside? So why do these, or what have these huge moves produced? Well, we can see that Ford, GM are all now getting into that sector. So what's that doing to Ford that had been kind of a slow moving stock? Ford hasn't changed any other than their outlook now is going to electric vehicles. That told us right away, right in here, that there was new buying, we could be buying this stock because of the signals right here. This is kind of what we call a doji sandwich. A bullish day followed by a doji with another bullish day with the doji sandwiched in between. That implies there's going to be more upside. You add the visual aspects, then look where this happened. Right smack dab off the 50, through this downtrending resistance level, stochastics coming out of the oversold area. This becomes a high probability trade setup. Same scenario right here on GM. Your piercing signal, and then bullish confirmation up through the T line, off the 50, puts us in the next move. This is nothing more than graphically analyzing what is occurring in investor sentiment based upon what the news is in specific sectors. So blink, the charging stations, you can see where the fry pan bottom broke out, had some huge profits in this. Now, this leads to that rhetorical question. Does every candlestick pattern give you a high probability of a big move? The answer is obviously not. But it puts you in situations where the probabilities of being in the right direction or in a big move is greatly in your favor. Let's see, I'm trying to. So this is how we use the rare research. If the candlestick signals are telling us there's a new change of investor sentiment, we now have people in our chat room every day that anytime we see a big price move, a pattern breakout, everybody goes back and checks the news so we know whether that news was relevant, that it's going to continue the uptrend. So this has been our big one here over the last few months. And I illustrate this because my most severest critic is my younger brother. And he said, well, how do you find the big moves? And I said, well, it's a very simple scanning technique. You go back and you find out which ones have had the biggest percent price move. And as I was showing him, I said, look at this one, OCGN. It's just gone from 15 cents and it's trading up here. So that's a breakout. So that's got the prospects of more upside. So he bought some for 73 cents. And as he was buying it, he said, well, they've got something where they've got a vaccine that they've been approved for India, and likely they can get approved in the United States. I said, well, if you're buying it, that's probably got some upside potential. Well, next day it was up here, so he more than tripled his money. But what this really showed us is the fact that when they came out of this dead trading, new investor sentiment came in. It alerted us to look at it and say, what's the news is creating this price move. So from there, we knew there was new investor sentiment, didn't really sell off, and then look at our next buy signal, broke out through this level. This then took it from about $3, and we finally closed out the trade somewhere up here in the 1773. Now, how did we know to take profits up here, that it wasn't going to go up another 50 points? Because we just flipped to the 10-minute chart. And when the 10-minute chart told us there was some selling going on, we started taking profits. Because what was the logic? The further away you move from the T line, the higher the probability human nature will start taking profits. So from that point, it's pulled back. Now it's trading lower today, but you can see kind of the curvature here. You got a hammer signal that bounced off the 34. Oh, so I guess I better go backwards here a little bit and say, here's the moving averages we have on our charts. The 200-day simple moving average, the 50-day simple moving average. The reason we have those on our charts is not because we're using them to make our decisions. We're using them to visually identify what everybody else's decisions are at those levels. A lot of people say, well, why don't you use the 200 and the 50 exponential? Aren't they better? And the answer is every major money manager around the world uses those moving averages to make their decisions. We want to see what their decisions are at those levels. I also have the 34 EMA. And this is the nice thing about a candlestick chart. The number one criteria for a change of investor sentiment is the signal itself. Everything else is just confirmation. If somebody says, put the XYZ indicator on your chart, well, if you put it on, at least you know the signals work and they constantly work. All we're doing is adding information or adding indicators on our charts that tell us that we got better probabilities of identifying a reversal. Now, here's again the most important one, the T line. As long as you stay above the T line, you stay long. Anytime you see a close back below the T line, you close out the position because the probabilities are extremely strong that now the bears are in control. Whoops, that's where it was. So today we can see kind of the rounding bottom. And today it's trading down here. So if it closes down here, it does two things for us. One, it tells us we're closed below the T line, we should be out of the trade. And two, look what it did to our curvature. Kind of negated that, made it a sideways chart. So the probabilities say close out the position. You can always buy back on the next buy signal. So this is what puts us in situations again. The rhetorical question is, do you always get a big price move? No. But the probabilities are that if you can identify the pattern, and remember, the patterns are developed by human nature, time after time, demonstrating that there's a buildup of investor sentiment. We're just identifying when it's going to start breaking out and put us in a high probability trade situation. Now, the reason we've got 6 or 8 patterns is because we know exactly what the results are coming out of these patterns. Usually it's big price moves. And we know when to come out of these trades. The further away you move from the T line, the higher the probability it's going to come back and test it. So when you move that far away from the T line, either one or two things are happening. Something great's happening, it's going to continue higher, or two, that's the exuberant buying, get ready to take profits. So this is kind of a rhetorical question. How long do you stay short? Well, you can see we had a bearish left-right combo. Didn't really confirm until Amazon closed below the T line. That told us the probabilities. And then here's kind of another just logical insight. If you see a bearish candlestick signal and you see a second bearish candlestick signals, the logic says the bears are starting to take control, especially if your stochastics are heading down. Notice where they popped it up a little bit, right off the 200. But what was our final criteria? They couldn't close it above the T line. So now we have a pattern that Amazon trading lower today. What do we have? A bearish J hook pattern, which is a downtrend, the J hook, and then more downside. And this is the benefit of knowing what the patterns are telling us. If this is wave 1, we can kind of calculate wave 3 will be that same magnitude. So here's the most powerful screen that we have, the T line. The T line acts like a Fibonacci characteristic. It's the natural support and resistance level of human nature. And I tell people, don't take our word for it, or my word for it. Put it on your chart and see how often it stays above the T line if you're using candlestick charts, how often that acts as a natural support level. And what the surprising thing is not only does it show you that it comes right back down to the T line, or a price might pull back right to the T line and bounce back up. It's not because everybody has the T line on their charts. Nobody has the T line on their charts. So as often as it comes and hits that T line and bounces back up, kind of reveals that's the natural support and resistance level of human nature. Again, if you use the candlestick signals, which is demonstrating the graphics of human nature or investor sentiment, and the T line is acting like a natural support and resistance level of human nature, the process or the trading strategy becomes very powerful, that you're in the right direction until you see a reverse and coming back through that level.
Steve, can I ask, just for clarity, we're getting a few people asking again, exactly what is the T line? So that's the 8 EMA, as I recall.
Right.
And they wanted a little bit of information on what your other chart settings are that you typically prefer to use.
Okay, here, let me go back some.
Yeah, and
All
I'll
right.
share a story while you're looking at that. When I first met Steve, he was teaching, and it was the absolute first time things triggered for me to be able to read price direction on charts. The candlestick signals just made it extremely easy for me to spot these reversals. So big fan.
Yep, and the sad part of that story is, after a couple weeks of her learning candlesticks, her husband called me one day and said, "I hate you." And I said, "Well, that's great. Why?" He goes, "Because my wife stays up until 2:30 in the morning analyzing candlestick charts. And so I always go to bed by myself anymore." So,
True story.
so anyways, here's how simple I keep the charts, because the most relevant factor on the chart is the signals themselves. I could take everything off this chart and use stochastics, which are slow stochastics, 1233, and the T line. Everything else is just more of a confirming indicator. Just with the T line and the stochastics and the signals. Again, the signals are the most relevant. You can make very good trading decisions. You just get better emphasis that, notice when they pull this back, it wasn't unusual, or it wasn't a magical that they bounced right off the 50. That was where everybody was watching to start buying. So the T line is the most effective. Again, the 50 and the 200 are what everybody else uses. And then the 34 works extremely well. And I say extremely well. Some people say, well, why don't you use the 20? You can put whatever you want to on your chart. They're all confirming indicators, or just giving you a better view. These are what are the most important facet of the trading, is the signals themselves. So if I see a pattern, the other indicator is the stochastics. Now I use 1233 because I'm a swing trader. My trades usually last anywhere from 2 to 10 trading days. And when I first learned candlesticks, which was, don't want to even say how many decades ago it was, they were using 1455, but that was a little bit slow. So I sat one night and just kind of tweaked to say, when a bottom hits, what is it doing at the bottom? When the stochastics are overbought, was at the top. So I just kind of tweaked it so they kind of corresponded with each other. Now, remember, we're not trading stochastics. A lot of people say, well, should you wait for the stochastics to cross or come up out through the oversold area? The oversold area is when your stochastics are below 20, or overbought when you're above 80. So this kind of defines the very simple analysis that the Japanese rice traders provided for us. If you see a candlestick buy signal, let me get to something where it looks. If you see a candlestick buy signal in the oversold condition, that's relevant. If you see a candlestick sell signal in the overbought condition, that's relevant. If you see a candlestick buy signal in the overbought area, that doesn't mean anything. or if you see a candlestick sell signal in the oversold area, that doesn't mean anything. Everything that you learn about or that I learned in candlestick analysis and that I teach is that it's all common sense put into a graphic depiction. You don't have to be a sophisticated analyst. All you have to do is recognize what's going on in investor sentiment. I tell people, prices do not move based upon fundamentals. Prices move based upon the perception of fundamentals. And candlestick charts are merely the graphic depiction of investor sentiment. We got any more questions?
Yeah, Steve, hey, this is Raleigh. A couple of quick questions came in. Number one, can this work on any time frame? And secondly, can it also be used to trade like futures markets and things of that nature?
I was remiss in not mentioning that. Candlestick signals are the graphic depiction of everybody buying and selling during a specific time frame. It works just as well on the 1 minute chart as it does the 5 minute, 15, 30 minute, daily, weekly, or monthly. And it's not a measure of a market. It's the measure of investor sentiment that involves anything that includes fear and greed, which is all investments. So you can be trading stocks, bonds, futures, currencies, tulip bulbs, anything that has human emotions in it. The graphics, the candlesticks are going to work. I used to trade the E-minis off the 1 minute, 3 minute, 10 minute chart combination. Right now, during the day, if I'm bored, which is rare, I'll trade futures on cattle, soybeans, the dollar, and I'll trade off the 10 minute chart. And it's a very simple process. This right here could be, now I was going to say that could be a 10 minute chart. But all these charts, to see if I can get to one that is, this could be a 10 minute chart. This could be a daily chart. This could be a monthly chart. So you use it for whatever time frame you're trading. If you like to trade actively intraday, you might use a 1 minute, 5 minute, 10 minute combination. If you
Steve, what about tick charts? Would it work on tick charts as well? Is that an increment, or does it need to be a time increment?
Oh, tick charts? No, it works on anything that people are buying and selling.
Gotcha. Got you covered.
So I guess before we take more questions, I should show us what our little special is. I've got 5 videos that show how to use the candlestick signals in conjunction with the T-line effectively. How you use them for buying and selling, your entry and exit strategies, the T-line crunch, the patterns that work more effectively with the signals. So it allows you to see much more clearly what's going on in investor sentiment. Now, I tell people you don't have to overanalyze these charts. It's just kind of obvious. And I kind of illustrate that with the story about the lady that brings her parakeet into the vet and lays it down on the table and says, "Can you fix my parakeet? He's been my best friend for years. There's something wrong with him." And the vet said, "Well, ma'am, I think your parakeet's dead." And she goes, "Oh, no. Can't you do something to check to make sure he's been my best friend? And I'd hate to lose him." He goes, "All right." So he goes out to the back of his clinic and brings in a cat, lays a cat down on the table next to the parakeet. He sniffs the bird, kind of looks up at the vet, kind of shakes his head and said, "Ma'am, I'm sorry, but your parakeet's dead." She goes, "Oh, are you sure? Isn't there something else you can check? Please, he's been my best friend." And he goes, "All right." So he goes out to the back of his clinic, brings in this great big Labrador retriever, comes bounding in, puts its paws up on the table, sniffs the bird, kind of looks up at the vet and shakes his head. And the vet said, "Ma'am, I'm sorry, your parakeet's dead." She goes, "Oh, man." So they go out to the front desk. And he goes, "Well, that'll be $250. She goes, "You're charging me $250 to tell me my parakeet's dead?" And he goes, "No, ma'am, I would have done that for $18. But then he wanted a CAT scan and a lab report after that. So you don't have to overanalyze candlestick charts. They're just simple graphic illustrations of what's going on in investor sentiment. Right now, Amazon, Apple, stocks are in a downtrend because the whole market or the NASDAQ is in a downtrend. So this makes the probabilities of having puts or short positions on that much greater as long as you're below the T line. So that's about all I've got for today. Any other questions out there, Raleigh?
Yeah, let me go ahead and bring up the question panel here. Okay, but a lot of remarks about your CAT scan and your
Okay.
lab. But no, but seriously, so I think once again, okay, just to Steve, just to make it abundantly clear, the T line is the 8-period exponential moving average.
Yes.
Correct?
Yes.
All right. Got that, everybody? It's the EMA.
Right. A lot of people say, why not the 10 or the 9?
Yeah, or simple moving average, SMA
Yeah.
or whatnot, but it's the EMA is what you're tracking.
Yeah. And just, as I say, put it on your chart and test it. I have a very simple policy. If somebody says, put the such and such indicator on your chart, if I put it on and after 2 weeks, I don't find it's helping me out any, I just take it back off. The more simple you can keep your chart, the more relevant each signal becomes. Everything else is just a confirming indicator at that point.
So another question came in a little bit earlier after your introduction, Steve, and you were talking about Japanese, candlesticks and the patterns, for example, that had a profound impact on you. And there are a lot of patterns out there. For somebody that's just getting into it, are there a few to focus on, right off the bat that can have an impact?
Yes. Now, there are a lot of patterns, or there are a lot of signals. There's 50 to 60 candlestick signals. But when I first started learning candlesticks, I was greedy enough that I wanted to learn every single one of them. And then I would go back through the charts to see if I would recognize them. And as I went through the charts and found the peaks and the valleys, or the bottoms and the tops, I discovered that 90%, not even 90%, 98% of the time, it was one of these 12 major signals. So I tell people, if you just learn the 12 major signals, that way you don't have to spend a lot of mental time and energy learning things that you're probably never going to see. And even if you do see one of the other signals, more than likely one of the 12 major signals is going to override it as being a better trade someplace else. Now I forgot what the question was.
No, it just, I think you answered. The question was, of all those patterns out there, are there a handful that you would recommend somebody that's new to candlestick analysis to focus on?
Yes. We have what we call the top rank signals and patterns. That's the combination of the signals in the patterns. Mm-hmm. For example, let me see. There's one right there. This is what we call the best friend signal. It's a doji. Remember, a doji tells you there's indecision between the bulls and the bears. And notice everything that happened on this trade right here. A doji in the oversold area, followed by a gap up. That's the best friend signal. We call it the best friend signal because it's got two major elements to it. One, the probabilities of going in this direction is extremely strong, or a bullish direction. And two, the magnitude of the move is usually going to be pretty strong. So when you start combining that all together, as I say, we've got about 18 top ranked signals and patterns, but I could give you a handful. The best friend signal is one. Right up here at the top, this is anytime you see a doji and a candlestick signal, it's going to be a little bit more powerful or a little bit more relevant. So a doji followed by a bearish engulfing signal is called a bearish left-right combo. The left being the little jab, the right being the big roundhouse right, tells you there's a major change of investor sentiment. Now, most of the signals we illustrate require confirmation. But if you see a left-right combo, you close it out immediately because the probabilities are that trade is over. And I forget which one it was that did a left-right combo. Oh, if you can pull up on your charts, I think it was I think it was INSG, did a left-right combo just below the T line, and then the next morning it gapped down a big percentage. So if you see a candlestick sell signal and a close below the T line, you close it out. So best friend, a kicker signal. A kicker signal, this is not a true kicker signal, but it's got the same elements. They open here and they close here. That's what creates the dark candle, the red candle. The next day, they gap it up and go the opposite direction. That tells you they've kicked the investor sentiment in the opposite direction. That's one of your strongest individual candlestick reversal signals.
Wow.
The fry pan bottom, as we saw in one of these, let's see, which one was it?
There you go.
Tells you if you see a fry pan bottom, you start watching to see what happens at the beginning of that pattern, because if they start breaking it out, that means the exuberance comes in pretty strong. And the J hook pattern. I think we were seeing that. This is what we call a J hook pattern. This is a bearish J hook pattern where they take it down and they bring it up. So we count it as wave 1, wave 2, wave 3. So a J hook pattern looks like a bearish J hook. And we have a pretty easy calculation. The probabilities are strong that it's going to go in this direction, and the magnitude is usually wave 1 and wave 3 are the same. I want to make sure I'm not running over time here on you guys.
No, we're doing great, Steve. You have about 8 more minutes.
Okay.
So from that standpoint, Andres asked the question, so with these patterns and signals in your hip pocket, like the best friend and others, do you trade option spreads as well, Steve?
Yes. You're not trading the options. You're trading the stock. The option is just a piece of paper that says I've got control of that stock. So if I was buying puts on Amazon because I expect it to go down here, well, an Amazon put may be $45, probably way more than what I could spend. But maybe I do sell or buy this one and sell this one and have a spread of whatever that was, $50, and maybe I've only had to pay $7 for it. That sure. I can afford to have that $7 go to $50. So the options, yes. If I'm buying a position and I'm not going to go out and buy 1,000 shares. I wish I could 1,000 shares of Amazon. I may be able to go and buy the options. So we do have an option trading room. We've got a lot of people in there. That what we do is we analyze what option strategy should we be using on a specific pattern. Sometimes you just buy the calls outright. Other times you might be buying a spread, or a combination of buying the calls and buying a upper price spread way out of the money, so that if it does work, that you've definitely magnified the returns of that trade.
Sure. Well, it's interesting, Steve. You made a comment a little bit earlier about if you ever find yourself at a point where you're bored during the day, which is rare, you might look at trading cattle or something else like that. And it just kind of struck me that you don't have to be an expert in that market. You're using essentially your stochastics, you're using your T-line, and you're using your candlestick patterns. You would basically plot that on any chart, regardless of what it is. And if you see an opportunity to buy or sell, you're going to exercise that decision. It doesn't matter.
Because that is the accumulative knowledge of everybody buying and selling that trading entity at that time. And you got to remember that the Japanese rice traders didn't become wealthy. They became legendarily wealthy, trading the most boringest commodity in the world in rice. That was rice. And it was all not because of price movement, it was because of human nature. And this is why they recognize the signals that told us there was a high probability that a result would occur based upon that candlestick signal or pattern.
Wow, that's fantastic. One last question just came in here from Jake, and I think this, this was touched on by some of our other speakers as well. And that is this: would you consider buying a bullish looking stock in a bearish market?
The statistics are that there's about 9,500 trading entities out there. If the market is going down, there's going to be some stocks that are going up. With very simple, easy scanning techniques from candlesticks, usually within less than 10 minutes each afternoon, I've found more bullish trades in a down market than I could handle, as well as more trades that I could handle on the downside on going short.
Sure.
So if you can, and again, that's where our rare process works, that if something has popped up in a down market, we immediately go see what the news was. If it was something where they've had something that's going to continue their upside, yes, we'd buy that buy signal in a down market. But the logic says if the market's heading down, the majority of our stocks or our trades are going to be on the bearish side. But that doesn't mean I'm going to be 100% short or 100% long in a bullish market. There's always going to be a good short in a bullish market, and there's always going to be a good longs in a bearish market. And the advantage we have is because we can do such simple scanning techniques to find the best trades, that at the end of the day, we're going to have more trades than we can handle. Now you can have a very simple process of going back and cultivating which one of those trades has shown the strongest potential to the upside. So you always have a supply of good trades, and then you can go and pick out which one's the best one of those good trades.
Well, that's great. Stephen, thank you so much for your time today. I know we had a little bit of an issue there at the beginning getting situated, but it was well worth the wait. It's always a pleasure to have you on board. I think the knowledge that you've accumulated over those relatively few years you've spent in the market, I mean, just the fact that we can sit here in the room and have you share with us the things that impacted you in your career has just been fantastic. Thank you so much for your time today. I hope you have a great day and a great rest of your week.
Thank you. And let me throw in the trivia question.
Yes.
This is related to rice for the rice traders and me watching Modern Marvels late at night. How many different varieties of rice are there in the world?
How many different varieties
of rice are there in the world?
Someone's posting a number. You tell us, Steve. What is it?
80,000.
What?
80,000 different varieties of rice. So
there you go.
That's something to remember if you don't remember the CAT scan and lab report.
No, I think we remember both your jokes, and the jar joke is priceless. So Stephen, once again, thank you so much for your time today. I'm going to grab the screen here, folks. That was Stephen Bigalow, once again, one of our most favorite people to have join us. And here we've known Steve for some time. And I just want to remind you, he put together a special offer for the Triple T trading strategies, which are techniques for timing the best trading entries, how to spot and profit from the T-line crunch, trading the fry pan bottom and slow curve for big games. So the offer link is westmarktrading.com/Bigalow. And I saw some last questions came in there asking about, are there books or articles or whatnot to read about candlestick signals? If you go to Steve's website, candlestickforum.com, he has published books on this. There are articles, videos, etc., everything that you need to know there about candlesticks to get started. So once again, Stephen, thank you so much for your time today. I hope you have a great week.
Thank you. Yep.
Steve, bye-bye.
Goodbye.